which means if you want to sell that, you're going to have to get a haircut. That's the price of lack of liquidity. So the bonds that have more liquid markets or more active secondary markets uh, can command lower yields. Two bonds may be otherwise equivalent. They're both yielding 3.5%. One of them is liquid, the other is not. I'm going to prefer the liquid one because some entities buy the bonds to keep until their maturity. Entities like uh, pension funds, for example, some people buy it for the purpose of trading. Or it's in your retirement fund. You want to basically dump those and go on vacation in some exotic Pacific island. Suddenly, you can't find a market to sell them at the current price. You can sell at anything fast if you're willing to get a big haircut. Another risk bonds have is, we already talked about that. Bonds also have interest rate risk. As you know, longer maturity, higher interest rate risk, uh, lower coupons, same thing. Or higher coupons have lower interest rate risk. I mean, if I wanted to sell a 2-year bond, uh, when the interest rates increase by 10 basis points, yes, I'm going to lose some money because as overall interest rates go up, all bonds will lose value. Fine. But the percentage loss I'm going to suffer is much, much higher on a 30-year bond, which means everything else being the same, same liquidity, same default risk. Let's assume for the sake of argument, there is no inflation, or inflation is going to be uniform overall. If a 2-year bond and a 30-year bond yields exactly the same return, I'm going to prefer the 2-year bond. Why? Because I'm exposed to less interest rate risk. So to accept being exposed to higher interest rate risk, I'm going to ask for a compensation, which means everything else being the same, interest rate risk essentially forces the market to accept, to require higher yields on longer term bonds. So a 30-year bond during normal times would have a much higher yield than a 2-year bond. Let's assume that short-term interest rates are going to remain same, inflation is going to remain stable. They're both U.S. Treasuries, so there's no liquidity or default issues. 30-year yields are going to be much higher because I want to be compensated for it. Oh, the biggest example of liquidity is the following. Yes, Treasury versus state. I'm going to show you, in fact, it was right in front of me. I don't know what happened to this mouse. Let me make it a bit bigger. Look at the 10-year yields are 381, 20-year yields are 422. That is expected. 20-year bonds are riskier in terms of interest rate risk, but suddenly 30-year bonds are a lot less yield. In terms of inflation expectations, trust me, market doesn't make any projections for the long term that is different from average inflation in 20 years versus average inflation in 30 years. If I took that literally, took that yield differential literally, That would mean market expects either the inflation or overall interest rates are going to be a lot lower between years 20 and 30 compared to the first 20. We know that's not the case. That difference comes from liquidity differences. A lot of those 20-year bonds are or were original 30-year bonds that were issued about 10 years ago. A lot of funds bought them and are keeping them, which means the so-called old bonds are a lot less liquid compared to the new bonds. It's even, there's a known pattern. Every 6 months, US does an auction of 30-year bonds. So I do a 30-year bond auction, market buys it. 6 months later, I do another one. The old bond becomes a 29.5-year bond. That's 29.5, 30. Why? There is no good reason, economically speaking, why their yields should be different, but they are. The new bonds have a lower yield, which means they command a higher price. Why? Because the new bond is a lot more liquid. In fact, at times like these, there is escalation of hostilities in the Middle East. If you actually looked at the numbers, 30-year yields actually went down. Probably 29.5 yields went up. That's called a flight to quality or flight to liquidity. There were hedge funds that actually uh, thrived on that differential. Back in 1998, the summer of 1998, Russia defaulted, or they declared a moratorium on foreign currency payments. That means, if they owed you in US dollars for a bond, they said, we're going to pay you, but I'll pay you in rubles, but at the old exchange rate. That's essentially default. There was a hedge fund established by one of the legends of the bond market. Have you guys, any of you, read the book Liar's Poker? You should. It's about the beginning of the corporate bond market in mid 80s and Salomon Brothers. And one of the top guys over there was a trader and manager named John Merriman. He was the legend of the bond market. And you can think of him as, I don't know, Google guys of the bond market. There was no corporate bond market to speak of before the Salomon Brothers and John Merriman. They made it an active market. And that started a lot of things like leverage buyouts. And you watched Pretty Woman, the movie? Richard Gere character was doing a lot of leverage buyouts with junk bonds and stuff. All that stuff started in Salomon Brothers and John Merriweather team. This guy established a hedge fund, long-term capital management. All they did was they found a strategy on paper that shouldn't be a differential, but there is. So they basically bought the 29.5-year bond or the old bond. They shorted the new bond. The yield differential was pretty high, but they kind of leveraged that 100 times. In normal times, that makes you a lot of money, and this hedge fund made a lot of money to its investors. And typically, the reward structure in hedge funds are: I charge you 1% management fee. So if you give me $100 million, you're going to pay me $1 million in management fee. Plus, I'm going to charge you 20% of the return over and above my benchmark. So if my benchmark is 10%, I made you 30. I'm going to charge you 20% of the 20, which is 4%. So I'll get another $4 million from you. By the way, those are taxed at 15% because of what's called, forget about it, something exclusion. They're taxed as if they're dividends, but they're not. Of course, but when the Russia defaulted, suddenly there was flight to quality and liquidity. The 30-year yields collapsed. and the difference between old and the new actually reverse sign, and it was big. I mean, normally that's not much of a problem, but if you're leveraging that 100 times, you're losing money 100 times faster. If Fed had not come in and saved the LTCM, the entire US bond market would have collapsed. Why? Because the LTCM was financing those by borrowing money from other banks. Since they couldn't pay those back, those banks would have gone under, which would have started a chain reaction. There's good reason, sometimes good reason why that's happening. So you can take advantage of those strategies, but don't go overboard in terms of size. All right. Mm, Of course, we already talked about it, but let's officially call it. Bonds have what we call taxability premium. Bonds that are taxable have to pay a premium over and above the bonds. Uh, in fact, I should all call these premiums. Bonds with higher chance of default should expect to pay higher rates. Bonds that are less liquid should expect to pay higher rates. Longer term or lower coupon bonds should expect to pay higher rates. Taxables also as well. And there is also the inflation premium. To give you about the size of the default risk premium, since I have Fred already available, I'm going to show you the average rate of the